In this video, we're going to see what are cash flows and how can you calculate them. The first thing we're going to see are the variables that determine an investment. So there are four. The first one is what we call the initial outlay. The initial outlay refers to the money that the company is taking from its own money in order to start the investment. So when you're going to buy a machine, for example, you can get some money from a grant, you can get some money from a loan, but you can also use your own resources. Those own resources that the company is using to start the investment are the initial outlay. Then we have cash flows. Cash flows refer to the future profit and loss of the company when making the investment. There's always some kind of expectation of getting money in the future when a company is making an investment. Let's think a little bit about it. Imagine the company is buying a new machine. They are going to use it to produce. But to use it, the company is going to need some employees and they will need to get some salary. So there's going to be a cost associated to the use of the machine. There's also going to be some raw material involved, and this raw material is also a cost for the company. The raw material is what the company is going to transform with the employees' help in order to make the final product. And the machine will need some electrical power to work, so this is another cost. This means that every investment is going to generate cost, expenses, and payments. But on the other side, the machine will also generate incomes and collections. When the company finally produces whatever, they will sell it to the customers, so there will be incomes and there will be collections. So every year the company is using the machine, they are getting incomes and expenses, collections and payments, cost and production. And these are the amounts that we're going to use to calculate the cash flows. How long are we going to do this? How long are we going to calculate cash flows? Well, it depends on how long the investment is going to last. If we buy a machine that is going to spend 15 years in the company, we will need to calculate 15 cash flows plus an initial outlay, which is going to be the cash flow in the year 0. And then there's a last concept you need to take into account referring to these cash flows, and that's the residual value. After using the machine for the 15 years, or as long as the company can use it, the company will try to sell it at the end of the useful life. They will try to get some money for that. So the cash flow of the last year will include not only the incomes and expenses and so on, but it also has to include the residual value. We'll see the formula in a moment, okay? Just for you to keep things in mind. Then there's a last variable that you can see in the slide, and it's the discount rate. What is a discount rate, or why do we need a discount rate? If I ask you, what do you prefer? You prefer to get 100 euros today or 100 euros in 5 years? What will you say? Probably you're saying 100 euros today, because we all know that the capital loses value with the time. So the same amount of money in the future will not allow you to buy as many things as now. And this thing that we know by common sense and by our own experience has an economical name. It's the underestimation of future capital. That's why we need a discount rate. That's why we need to transform the future capitals into today's capital. So we need, let's say, to move those capitals in time from the future in which they are to the present moment. That will help us to have the right amount of money to compare what we have to put to buy the machine and what we're going to get in the future by using that machine. I also have a last warning for you. Cash flows reflect the future. This means they are not real. They are predictions of what the company thinks it will happen. This means that if the company is wrong, there could be 1,000 situations in which the cash flows are not the ones that the company estimated. But companies do not have any better way to take decisions, so they use these cash flows as if they were real. But you always have to keep in mind that they are not real. They are estimations of what the company thinks it's going to happen. Let's see how are we going to calculate cash flows. We're going to need, let's say, two different formulas, and one of them it's going to have a special variation for the last year. Let's start with the two first lines you have in the chart. You have the initial outlay and the residual value. And as you can see, there are two squares that are colored in red. That means that that's the only moment in which those concepts are going to appear. So the initial outlay, you're only going to calculate it for year 0, and the residual value, you're going to place it only in the last year of the investment. Let's start with the initial outlay. The initial outlay represents that the money the company is using from its own money in order to get the investment. So we're going to calculate it as total investment minus loans minus grants. And that formula will tell you how much money is the company using from its own funding in order to get the investment. Then we have the residual value. The residual value only appears in the last year of the investment. We have already seen this concept. Remember, when the company buys a machine, uses it as much as possible, and at the end of the useful life, the company is able to sell this machine and get some money from it. They are not going to use it anymore, but they can sell it to another company or whatever, and they can get some money. That's the residual value. And that's why it only appears once, and it only appears in the last year, because that's the moment in which you sell the machine. So be careful with these two things, because they only appear when you have the red spots. Let's see how to calculate a regular cash flow. The first thing you're going to have are incomes. Why do you have incomes? Well, you're buying a machine, you're going to use it to produce, and you're going to sell that production. So you're going to have incomes from those sales, from that production you're making. Then we're going to have production expenses. In order to get the products, you will need to use some raw material, you will need to pay some salaries, you will need to pay some electrical power. So those are production expenses in general. So we're going to do incomes minus production expenses. And there are two production expenses that we're going to place in a separate line, and those are the legal depreciation and the financial interest. Why are we placing them apart in a different line? Well, we're doing it like this because they have a different consideration. They are production expenses, but they have a different consideration. That's why they need to appear in a different line. On the one side, you have legal depreciation. You already know what this is. When you use the machine, it depreciates. So this is the legal part of the depreciation, and we're going to use it a little bit later again. That's why we put it in a separate line. Then we have the financial interest. Financial interest are those interests that come from a loan, the loan that you're using to buy this machine. That's why we put it in a different line. Okay, so in order to get the first result, that will be the economic result, you have to do incomes minus production expenses minus legal depreciation minus the financial interest. And yes, this is the economic result we studied in the first lesson of this course. It's exactly the same one. What is different is what we're going to do from now on with it. First thing we're going to apply are taxes, business taxes, and these are defined by law. Every country has a different regulation, so every country will tell you what are the taxes that the company has to pay. So in this case, these are the business taxes. and we will do economic result minus business taxes. Then we will add bonifications. Bonifications are when the tax office does not want the company to pay so much taxes, so they get a bonification. We're not going to work with this in the exercises, so I'm just placing it here so you know where it goes, and if you need in the future, you know how to do, what to do with it and how to do it. Once you do this, you get the net profit. However, this is not yet the cash flow. We need to transform this net profit into cash flows. So to do that, we're going to add legal depreciation and we're going to subtract the loan reimbursement. Why are those quantities again in a different line? Well, legal depreciation, if you remember, was something that the company was not paying to anyone. They were savings. So when you calculate the profit, that profit is supposed to become money, liquid money that the company is going to use. But in order to have the cash flows, you need to add legal depreciation because that money is not going anywhere. We're not paying it to anyone. That's why you need to add it. And you may think, okay, why did we subtract it before if we're going to add it now? We subtracted before because we were calculating all the production expenses. We're adding it now because we're calculating what part of the money is really moving, what part of the expenses is really becoming a payment or not. That's why we have this different, we have it twice, once on top, once now. And then you need to subtract loan reimbursement. You need to take into account that this money is leaving the company. Okay, so once you have net profit plus legal depreciation minus loan reimbursement, you have the cash flow for that year. Except in the last year. Because in the last year, in order to get the cash flow of the year, you need to add the residual value. So the red square you have on top. And remember that for the first year, we're not doing any of this. We have this special formula, total investment minus loans minus grants. That's going to give you the initial outlay. That's going to be the cash flow for year 0. However, there's a shorter way to do this. If you have already prepared the payment, expense, and cost table, you already have a lot of information there. So you don't need to do the long thing in order to calculate the cash flows. You can use the formula that you see on the screen. You have the economic result, so you can just subtract taxes, add legal depreciation, and subtract loan reimbursement. That will give you the cash flow. It's going to be exactly the same as the big chart you've seen before, except for the first year, the initial outlay, and except for the last year that you need to add the residual value. But keep in mind that since you're already done the first part with all the expenses and costs and incomes and so on, you can use this short formula in your exercises. I hope this helps and see you in the next video.